Venture capital is often viewed as a glamorous world of billion-dollar bets, game-changing technologies, and visionary founders. While this perception captures some of the excitement, the real day-to-day life of a venture capitalist is far more grounded and more demanding. It's a profession that requires constant motion, careful judgment, and long-term commitment. From raising money to fund their investments, to hunting for the next breakout startup, to supporting founders through highs and lows, VCs operate at the intersection of finance, strategy, and human potential. Understanding what really happens behind the scenes means looking at every stage of the journey. Before a dollar is ever invested, capital must be secured from limited partners. Then comes the never-ending task of sourcing promising deals and building meaningful relationships with founders. The best ideas must survive a rigorous due diligence process, and the work doesn't stop at the point of investment. VCs must actively help their portfolio companies grow and evolve, guiding them towards successful exits. Before a venture capitalist can invest in any startup, they need capital to work with. This means raising a fund, a pool of money provided by outside investors known as limited partners or LPs. These LPs can include institutional investors like pension funds and university endowments, high net worth individuals, family offices, corporate venture arms, or fund of funds that specialize in backing VC firms. Fundraising is one of the most strategic and complex responsibilities that a general partner or GP undertakes. In many ways, it mirrors the process a startup founder goes through when pitching their business to VCs. The GP must craft a compelling investment thesis that articulates not just what they plan to invest in, but why they're uniquely positioned to succeed. Are they focused on early-stage fintech, climate tech, AI? What trends are they betting on, and what networks can they leverage? Once the thesis is clear, the GP embarks on a roadshow, meeting with potential LPs, fielding challenging questions, and building the relationships that form the foundation of the fund. They present a detailed fund prospectus outlining strategy, expected returns, fees, and governance structures. Negotiations can be lengthy, especially when discussing carried interest, the GP's share of the fund's profits, or the fund's duration, which can stretch over a decade. Even after a fund is successfully raised, the relationship with LPs doesn't end. Regular communication, detailed performance updates, and transparent reporting are essential. LPs want to know how their capital is being deployed, what challenges are emerging, and how the firm is positioning itself for long-term success. Maintaining this trust is crucial, especially when it's time to raise the next fund. Before finding the right deals, it is essential to know where to look, and that begins with market analysis. For venture capitalists, understanding markets isn't just about reading research reports or tracking trends. It's about forming a point of view on where the world is headed and where real opportunities are likely to emerge. This analysis starts with identifying macro shifts, demographic changes, technological breakthroughs, regulatory trends, or shifting consumer behaviors. A VC might notice rising urgency around climate resilience, new infrastructure for AI, or evolving supply chains in global commerce. But high-level insight alone isn't enough. The real skill lies in translating these big-picture movements into focused investment themes. What new companies might these trends enable? What pain points remain unsolved? What infrastructure still needs to be built? And just as importantly, who's already working on it? By answering these questions, market analysis becomes a compass for sourcing. It helps investors move from a sea of possible startups to a targeted search within specific domains. For example, if you're convinced that synthetic biology will reshape agriculture, then you'll start scanning university spinouts, following specialized research labs, or tracking niche accelerators that operate in that space. A thoughtful market analysis sharpens deal flow. It helps you proactively seek out the founders and startups who are building in the spaces you believe in. Rather than passively reacting to whatever lands in your inbox, you're scouting with intent, guided by a thesis and more likely to find the hidden gems that align with your long-term vision. Once capital is in place, the real hunt begins. At the heart of venture capital lies the search for the next transformative startup. But the best opportunities don't usually walk through the front door, they have to be discovered. This is where deal sourcing comes in. There are two main types of deal flow, inbound and outbound. Inbound deals are those that come to the VC, often via warm introductions from founders, other investors, or industry peers. Some arrive cold through direct outreach or pitch forms on the firm's website. While inbound can bring interesting leads, the highest quality opportunities are often found through outbound efforts. Outbound deal sourcing means proactively identifying startups before they begin fundraising. This requires being deeply embedded in the startup ecosystem, constantly plugged into what's happening in accelerators like Y Combinator and Techstars, visiting university labs, attending demo days, and tracking emerging talent through GitHub, Product Hunt, or industry Slack communities. It also means building a reputation as a helpful, founder-friendly investor, so that when great startups are ready to raise, they think of you first. Top-tier VCs don't wait for deals, they chase them. They stay in close contact with angel investors, scout networks, early-stage advisors, and startup lawyers who often have the first look at new companies. In many ways, the VC must act like a journalist or a detective, curious, resourceful, and always looking for the next story before it hits the headlines. After a promising opportunity is identified, the next step is meeting with the founders. This first conversation is one of the most critical moments in the investment process. It's not just a pitch, it's a dialogue that offers deep insight into both the business and the people behind it. Unlike traditional finance, where decisions are often made based on spreadsheets and models, venture capital puts an enormous weight on the team. VCs are not just evaluating a product, they're trying to understand whether this is the right team to build a world-changing company. They're looking for vision, grit, self-awareness, and an ability to execute under pressure. During the meeting, investors will ask questions that probe both the business and the market. What problem are you solving? Why now? What shifts in the market make this the right moment? What is your unfair advantage, your moat? How do you acquire customers, and how scalable is that process? What's the revenue model? What traction do you have, and what milestones are you aiming for? But beyond facts and figures, it's a chance to understand the founder's mindset. Are they coachable? Do they have clarity of thought? Can they attract great talent? And equally important, it's a chance for the founder to assess whether this VC is someone they want on their cap table. The best founder-VC relationships are based on mutual respect and shared ambition. If the first meetings go well and the firm wants to explore further, the process enters a more formal phase, due diligence. This is where the excitement of a promising startup is tested by the discipline of rigorous analysis. The diligence process usually begins with market research. Is the market large and growing? Who are the competitors? What barriers to entry exist? The goal is to understand whether the startup has a real chance at capturing meaningful value in its space. Then comes a financial deep dive. What is the company's burn rate? What are the unit economics? Are revenue projections realistic? Is the business model scalable? Even at the early stage, VCs want to know whether there's a clear path to a significant return. Product diligence is equally important. Many investors will test the product themselves or bring in technical experts to evaluate the tech stack, user experience, or scalability of the platform. Customer references, churn data, and adoption metrics can also provide crucial insight. And of course, founder diligence is critical. Investors conduct background checks, talk to former colleagues, and call other investors who may have worked with the team in the past. They're looking to understand leadership qualities, work ethic, and how founders respond to adversity. Finally, legal diligence ensures there are no skeletons in the closet, issues with IP, unresolved lawsuits, or cap table confusion that could derail a future exit. Once all the pieces are in place, the team compiles a formal investment memo and presents it to the partnership for final approval. Once a deal passes due diligence and the team feels confident about moving forward, the final decision often rests with the investment committee. This is where emotion meets structure and intuition is tested by rigorous debate. The investment committee, or IC, is typically composed of the senior partners of the firm. It's their job to ensure that every investment meets the fund's standards, strategically, financially, and ethically. Even in firms with a more collaborative culture, the IC process introduces a level of accountability and discipline that prevents hasty decisions or personal bias from driving the portfolio. To present a deal, the responsible team member prepares an investment memo. This document synthesizes everything learned during diligence, the market opportunity, the strength of the team, the product's differentiation, financial metrics, risks, upside potential, and proposed terms. The memo is both a pitch and a test. It must anticipate tough questions and provide clear, reasoned answers. During the IC meeting, partners probe every angle. Are we overestimating this market? Is the team really the best in this category? How defensible is the technology? What's the exit potential? Are the terms justified? The goal isn't to create friction, but to pressure test the investment before a dollar is deployed. Sometimes, the IC reaches unanimous consensus. Other times, deals are declined, delayed, or sent back for more diligence. And in some cases, a partner may choose to champion a deal despite skepticism from others, putting their name and reputation on the line. The investment committee is a safeguard, but also a forum for conviction. It's the moment where a promising idea transforms into a committed investment, and where the venture capital firm as a whole takes ownership of the decision, ready to support the company for the long journey ahead. Once the investment is made, the real work begins. Many assume that VCs write checks and simply wait for an exit. In reality, managing a portfolio is a long, active process that can last 5 to 10 years or more. VCs often take board seats, participating in strategic decisions and governance. They help founders refine their go-to-market strategy, optimize operations, and plan future fundraising rounds. They make introductions to customers, hires, and follow-on investors that can unlock exponential growth. They also serve as a sounding board in difficult times, helping founders navigate layoffs, product pivots, or internal challenges. While some firms take a hands-off approach, the most effective investors are deeply engaged. They act as partners, not just financiers. Over time, as companies mature, VCs help prepare them for potential exits, whether through acquisition, IPO, or secondary sales. They assist with financial planning, investor communications, and negotiations. Portfolio management is where relationships are tested, trust is built, and long-term returns are ultimately realized. The life of a venture capitalist is anything but routine. One morning might start with a breakfast meeting with a founder pitching a climate tech solution. The afternoon could involve a deep dive diligence session with the investment team, followed by a call with LPs about fund performance. In between, a partner might be helping a portfolio CEO recruit a VP of sales or prep for a Series B round. The pace is fast and the demands are varied. VCs must constantly juggle short-term opportunities with long-term commitments, making decisions under uncertainty and managing relationships across multiple fronts. It requires context switching, deep focus, and the ability to see both the big picture and the granular detail. It's also a role where curiosity and hustle matter as much as intelligence. The best VCs are students of the market. They read voraciously, attend events, follow trends, and maintain an ever-growing network of people building and investing in the future. Venture capital is a profession built on belief in people, in ideas, in the future. It's not just about capital allocation, but about partnership, mentorship, and vision. From raising funds to scouting hidden gems, from asking hard questions in diligence to standing shoulder to shoulder with founders through the messy middle, VC is a long game built on trust, timing, and insight. For those looking to enter the field, understanding the mechanics is just the beginning. True success in VC comes from immersing yourself in the startup world, building relationships, developing your judgment, and thinking like an investor even before you officially become one. Because in this industry, the best opportunities rarely shout, they whisper. And it takes a trained eye, a curious mind, and a lot of legwork to find them, nurture them, and help them grow into something extraordinary.